Welcome back, FPS 705 class, to this next online lecture that we have together. Importantly, what I'm going to be taking you through this particular lecture video is I'm going to be taking you through a valuation model in practice. Now, granted, because it is a valuation model, it goes beyond that's what you're going to be expected to do in any test or exam at an FPS 705 level. However, that being said, I still think it will be useful for two reasons. Firstly, I think that it will provide context for what you can expect, particularly if you're looking at going into the banking or the tip route for your psycho articles. Because this is what you will be expected to do in certain rotations. The next reason why I think it will be important is because it will give an overview picture of the valuation process. In other words, we'll look at the capital structure, how the capital structure impacts on my weighted average cost of capital, and how this is then embedded into my discounted cash flow or DCF method in order to determine the value of a particular company. So the starting point of any valuation and the starting point for what we're going to be doing today is we're going to be looking at the underlying characteristics of the company. And the reason why this is important is because it drives the valuation method that we are going to be doing. Now, granted, the valuation model that I'm going to be taking you through today is an old 2014 valuation that I performed. But it still provides the necessary details, and the skills that we're going to discuss are transferable. If you would just like a little bit more information on the modeling aspect, on what I have done, and on the process to be followed in case you want to carry out your own valuations, please refer to your career textbook. In your career textbook, particularly chapter 20, pages 21, all the way through towards the end of the chapter. Now, the first starting point for any evaluation and everything that we need to do is looking specifically at the company we are trying to value and the underlying characteristics of that company. And the reason for this is because it drives how we are going to approach our valuation technique. If we've got a valuation, or if we're performing a valuation, and we're looking at a non-controlling interest, we're looking at a valuation technique which takes dividends into account. If we're looking at a controlling interest, we then need to determine whether or not the company is as a going concern or not. And you'll recall these are the thought processes that we need to do in terms of following that methodology to determine the most appropriate measure. And for more information, if you're unsure about this, please refer back to this first online lecture video where we discuss value. Now, in this particular question and the valuation I'm going to be taking you through today is going to be a company by the name of York Timbers, and you'll see it there on your screen. So York Timbers is an integrated forestry company, and it is the only company of this particular nature on or listed on the JSE. All right, it trades under the code name YRK, and at the time of me performing this valuation in 2014, the company was trading at a share price of approximately R3. So that just gives us a little bit of contextualization about this particular company. Additionally, as you become more intuitive or as these valuation models become more complex, we also need to know the underlying characteristics of the operation, because this is going to drive the value of this prospective company. When we looked at York Timbers, the most important thing to identify was the life cycle of a tree, which essentially, from the day that it was planted until such time as it could be cut down, stripped, and then sold to the various customers, it took 21 years in its entirety. Which meant that we needed to have an explicit year for at least 21 years to take this into account in our valuation methodology. So that just gives us a little bit of broad perspective. So having decided or having known that we are looking at York Timbers, the next process or the next step for us to do in order for us to determine the value is to start right at the beginning. And the question we need to ask ourselves is, where is this? Because you'll recall when we started looking at WACC that we have cost of capital, Cost of capital influences my weighted average cost of capital, and my weighted average cost of capital influences my valuation, which in turn impacts on my capital structure. So in order to start this particular process, what I'm going to do is I'm going to look first and foremost at the capital structure of this particular company. So if we go to the model all the way through, let's look at the capital structure. So what I did when looking at this particular capital structure, I determined what the existing capital structure of this particular company is. And I determined that the current capital structure is looking at a basis of 21%. Then what we needed to do is we needed to say, all right, well, if we go forward, what adjustments might we need to make to this particular capital structure? And this has become less important in recent times because of the adoption of IFRS 16 and leases. But we need to take into account that my operating lease payments represent a certain source of funding. As a result, I now need to capitalize them and incorporate them into my capital structure. And as a result, this is going to change the capital structure of my entity. So what I needed to do is I needed to determine what this capital structure was for that respective entity. That became my starting point. The next aspect, having looked at the capital structure, is I needed to go and I need to determine what the company's WACC was, the company's weighted average cost of capital. Why? Because when I'm discounting my free cash flow to the firm, I needed to take into account that particular capital structure. So if I'm looking at my company's weighted average cost of capital, I know that the capital or that the WACC is made up of certain components. In this particular company, York Timbers, I had a cost of equity as well as a cost of debt. So what did I need to do? The first thing that I needed to do was determine my cost of equity. So using my cost of equity, I needed to look at my CAPM method. So I've got my beta, and my starting beta was 0.32. Now, there's many ways to go and get about it. In practice, what many companies do is they just look towards Bloomberg or they look to other measuring techniques. But if you want to look at the underlying core constituents as to how we determine the beta, this is how it was done. And this essentially shows you what beta is. So the first thing that we needed to do when we're looking at the beta is the variation of a company's return given a certain change in the markets. So what did I do? I looked at the York Timbers historical share price for all the different days. And I plotted all that information and I got that from IRIS. The next thing that I needed to do was I needed to determine what the all-share index, in other words, the JSE market return was, and I determined what they are also from IRIS. So these are just direct extracts. I then looked at the daily change in both of these measures to determine what the relationship was between my stock returns and my market returns. So if I'm looking at this, you can see I've looked at my starting point, ending point, divided by my ending point to get my return change. I did the same thing for my stock change, and I did the same thing for my returns index. And I just plotted it all the way down. So when I looked at it, I looked and I had information for the last 5 years, and then I calculated a beta. Oopsie. And then I calculated a beta for different periods. So for instance, I've got a 5-year beta, a 2-year beta, and a 1-year beta. How did I determine this? I looked at the covariance of my stock returns relative to my covariance or my variance of my market returns. Which meant that if I'm looking at my 1-year beta, as the market changes by 1%, my share price, my York Timber returns, changes by 0.31%. The next question we need to ask ourselves is, well, does this or is this realistic, yes or no? Well, to answer that question, we've got to go back to the core understanding of what this company does. So if you think about this company, where is the majority of its value lying? Well, to answer that question, the value is lying in its forestry and its trees. And if we think about the tree, those particular trees, is it going to change drastically year on year? And the answer is no. So as a result, it should be a relatively stable stock with a stable return profile. So that does make sense. So hopefully that also just gives you a bit of contextualization as to what beta is. If you want to look at how this is plotted on a particular graph, what we do is we see my market returns shown with the straight line, and then you've got the overall daily returns relative to that of the markets. And that's essentially, that change is what we're looking for when we're looking at my beta profile. So that was step one in the process. What did I now need to consider? Well, when I'm looking at my beta, this beta, and we discussed it when we looked at weighted average cost of capital, this beta was based on the market's debt equity used. But what do we know about going into the future? If we go back to my cost of capital structure, I know, if we go back to my cost of capital structure, I know when I'm looking at these particular figures that my debt equity is going to change as a result of having to take on or add my operating lease payments. And when I'm looking at my weighted average cost of capital, I always want to consider a forward-looking rate. So what did I need to do? I needed to unlever my beta and then relever it again based on my forecasted debt equity ratio to get me to my relevered beta. That then becomes one of the inputs that I need for my cost of equity calculation. Got my risk-free rate, which was just represented by one of the bonds, and I had a common market premium of 6.5%. I added the premium to that of 6 or 2.8% to get me to my total cost of equity. And the reason why I added the small cap premium was because this share, York Timbers, does not have a lot of volatility, does not trade every single day. And if you look at the historical information, you'll find that that is the case. So as a result, I added a premium for that. In other words, I'm increasing my discount rate, decreasing my underlying value because of that very factor. Again, this is where the subjectivity of any valuation comes in. And that gave me a cost of equity of 13.36%. I then looked at my cost of debt, and I looked at the overall debt facilities that the company currently had and the cost of that respective debt, and I determined the overall forecasted KD. So when compiling it and putting into my weighted average cost of capital, I needed to use my same debt equity that I used it in, relevering and unlevering the beta. In other words, I want to make sure I compare apples with apples. Once I've done that, I've got my cost of equity, I've got my debt, then it comes down to my taxation rate. So you'll see over here, what I've done is I've used a 27% tax rate. Now this comes down to what the question is asking you on the day. In this particular example, I was looking for the market value. In other words, the value specific to buying York Timbers, not for the fair value. And as a result of me looking for the market value, I wanted to take the company-specific profile into account. And as a result, in order for me to do that, I looked at the effective tax rate paid for all of the last 10 years. And that gave me an average of 27% that I use in terms of my calculation to get to my overall WACC structure. What you'll see, and something that you'll be exposed to as you get into practice, is we build in certain buttons. The nice thing is that if you're presenting to a client or you're presenting your valuation, it becomes very, very easy to overall change the value. So, for instance, what happens if I decide to reduce my small stock premium? Not 2.8, I find that's a bit bullish. So as a result, I'm going to decrease it, and I'm decreasing it to 1.5. As a result, we see what does that do to my total cost of equity and what does that do to my overall weighted average capital. So it just brings in a little bit of flexibility. So as you're doing your client presentation, it is taken into account. All right, so now I'm happy. I've got my beta, know how we calculated that. I've got my weighted average cost of capital, and I've got my capital structure, which is reflective of me bringing on those operating or those operating leases. Now I get down to the actual valuation that I need to perform. So for me to perform the valuation, it's made up of multiple components. Having gone through both the capital structure and the WACC, the next component that we need to do is we need to actually compile the valuation. Now, in a test or exam, what you will be faced with is the decision or whether or not you have been given forecasted information or you'll have to forecast information yourself. In this particular example, as we are obviously dealing with a publicly available information, what we would need to do is we'd need to forecast that information ourselves. Now, in order for us to be able to forecast this information, the most important thing is to look at the historical trends, because hopefully the historical trends give us an indication of information to come next. So that's what we do in the next step. So just to actually give you an indication, we look at the forecasted information. So what I do when I'm looking at this is I look specifically at the various assumptions. So if I'm looking at revenue growth, I determine what the revenue growth is going to be for the forthcoming years. As the gross margin and the revenue is the most important components, I do these calculations separately. Now, obviously in a test or exam, just be guided by the information, whereas this, because it was a main driver, we did a separate calculation. And in terms of this particular separate calculation, we looked at the historical sales growth in the industry, market share, net market growth, and we increased by inflation. All right, that's obviously very, very technical, over and above what you might require, but just to give you some indication as the level of detail that is required in order to estimate both the revenue growth and the margin. We then looked at, similarly to that first lecture example that we did in class together, we looked at operating expenses, investment income, finance costs, and everything as a percentage of my revenue figure for each of the respective years. CapEx, same thing for intangible assets then, and so on and so forth. And what we did with this information was we forecasted all the financial statements of York Timbers. So you'll see there's revenue. Revenue is driven by the revenue assumption, and so on and so forth for all the respective years. And we do the same thing for all the expenses. So that just gives you a brief indication of what we did in the valuation model. Once we had forecasted all the information, we then used this information in order to determine the free cash flow of the entity. Just going back one step, if you are doing this yourself, just please a reminder to try and do your financing cash flows, in other words, how you make up that financing component. And you must just make sure as a check that this balances. And then additionally, what you'll also find the complexity, and the career textbook goes into it into nice detail. What we actually need to do is if we're forecasting financial information, we know each and every year that the company is going to generate profits. As a result of generating profits, the retained earnings is going to increase. What we need to do is you need to incorporate a like increase in my cash balance each and every year. This becomes a circular reference issue because as my cash balance increases, so too do other factors. So what you need to do is you need to enable circular referencing on your Excel model. But the career textbook goes into nice detail about this. That's not the purpose for today. The purpose is to show you an overall financial overall valuation. So you see there, similarly to other lecture example, we did a recon on PPE and a recon of my intangible assets to determine what those net purchases were going to be. Same thing, forestry plantation linked with my PPE and so forth. I look at my net working capital and I determine what those particular changes are each and every year. And then I compile my valuation. So if I'm looking at my valuation, what do I need to do? I've got my earnings before interest and tax. I then deduct my tax expense figure that I've calculated. Now remember, I'm working, or I've got a forecast financial information, so I can just multiply it by the respective tax rates. I add back my depreciation amortization to get me to my operating cash flows. Once I have my operating cash flows, I've got to remove all my capital expenditure each year, along with my movements in my net working capital. What you'll see, and I've already discussed it, in this particular valuation, we looked at the life cycle of a tree and we used this as a basis for our explicit period. So you'll see it's a base of 21 years. And what we do is we determine the value, the net present value of these future cash flows. That represents my T1, the value or the present value of my explicit period. What I also need to do is I need to determine the value into perpetuity. And so for that, I need my terminal value. Terminal value, I need to have my constant growth rate. For this, we use my sustainable growth rate of 2.12%, which was calculated at a later stage or in a previous step. I then have got to look at my free cash flow. In other words, what is my free cash flow in that final year? And we'll see that goes to my 2021 or 2036 figure. And then I use this amount, and then I use this to determine my terminal value. So what do? I've got to increase my final year for 1 year's constant growth of the 2.21%, and then I divide by my WACC minus G. Importantly, you'll see the WACC, everything has got a link, so that's got a link to my WACC, which is calculated above, which in turn comes from my WACC calculation in a separate tab. And if we're shifting down, that gets me to a terminal value of 535,000. And then I add these two together to get me my value of operations. Onto my value of operations, I've got to add all my dissimilar assets. Sorry for the pause there. My dissimilar assets, and you'll see I've got my investment property, I've got my other financial assets, excess cash, and then I have to deduct my sources of finance to get me to my value of equity. Now, when I'm looking at my loans and borrowings, I'm taking the fair value of those obligations. I've got my retirement benefit obligation and my cash settled share-based payments obligation. Adding all those figures together, that leads me to my value of equity, divide by the number of shares in issue, and I get a share price of 3.74%. What I also did, just as a bit of a reasonability, I looked at an explicit period of 10 years, so slightly shorter. We will see there that obviously my terminal value is a much larger proportion of the overall balance. Why? Because it's a shorter time period. Yeah, present value or my terminal value only comes in from year 22. Yeah, it comes in from year 11. And I get a share price of 2.85. And obviously the difference in there is explainable. Why? Because we've got a higher growth in my explicit period relative to the terminal value growth. And we can see that these figures at the bottom of the year, 2.2, 2.7, 3, 2.84, 2.95, etc., etc. And those are driven by the assumptions that we calculated previously, based on the industry sales, the market demand, etc., etc., that drives that. So this then determines my overall value. Now, Mr. Plant, when he would have gone through some things, he would have gone through with you looking at the reasonability of these figures, looking at reasonability checks, determining alternate valuation methods, and that's the same thing that we have to do in practice. So in practice, you look at a whole bunch of different reasons to determine the reasonability. So a couple of things that we look at is we look at my terminal value multiple. In other words, what proportion or how big is my multiple in terms of the overall valuation of the share. And then I do other aspects and I do other checks. In other words, I look at my return on assets, my return on investments. If I see that these figures get too high, it would indicate that I've done something wrong in my calculations. The last and final step is I just perform some kind of sensitivity analysis to determine the reasonability of these particular figures. So in this, I look at the changes in my share price versus my, for instance, WACC. And we'll see there if WACC decreases or WACC increases, what that's going to do to my overall share price. And then look at other factors. So look at WACC, my change in operating expenses, my changes in revenue, etc., etc. And what we'll see is that the most sensitive aspect, if I look at what's referred to as a tornado graph, the most sensitive aspect is my operating expenses as a percentage of revenue. So the bigger my operating expenses, the more change it's going to have in my final value. And if we take a step back and we ask ourselves always, does this make sense? Well, yes, it does. Why? Because a large portion of the costs in this particular business are fixed in nature. If these costs increase or decrease drastically, it's going to have a big change on my overall value of this particular share. So what did we conclude with this particular valuation? Well, we got a value between 3.74, 2.85. It was trading at around 3. If we take into account some margin of safety, it would mean that the share price currently is existing. So the overall recommendation that we had for this particular share was a hold. Importantly, and most likely would have been discussed previously, but we always have either a hold, a buy, or a sell, depending on the share value, the intrinsic value that we are calculating by this valuation relative to the market price that's currently in the market. All right, so we had a hold on that particular share, and we'll see from the share trading history, and I'll bring it up for you guys shortly. If we look at the share trading history of this particular company, what did we end up with? We ended up with a high of approximately R40, and now it's sitting at 11 or R1.11. And this is an important principle just for me to end on. And the reason why it's important is that a valuation isn't set in stone. So what we need to do is once we've performed a valuation with the available information, as more information becomes apparent, as a company updates its financial statements, as it releases new trading reports, those valuations always have to be revisited. And each and every time we come either with a buy, a hold, or a sell decision. Now, I'm hoping that this video made sense to you. I'm hoping that it added a little bit of light to the picture as what we do in practice, and hopefully you found it insightful. And it's going to help you not only with valuations and models, but it's going to help you with the overall picture of what we are trying to do. Thank you very much, and good luck for the rest of the module. Cheers for now.